morning, everyone. Thank you for joining us. This is Jawahar Al-Tamami. I'm the board secretary. I'll just introduce you to management. We'll be presenting the financial results of the second quarter of this year. We have Abdullah Al-Hinai, our chief executive officer, and Gri is joining us remotely as a chief financial officer. And we have also Aisha Al-Musa. She's the investor relations officer, Swami from business performance, and Mustahil Ma'mari, head of strategy.
Yeah. Good morning, everyone. Thank you for taking the time and meeting with us. We have a small presentation, but we can be guided and driven by your requirement. A lot of the information here were quite known in this market. So with that, I'll start with the slide, but if you want me to move faster, do let us know. On slide 5, these are the key messages that like the investor base to understand about National Bank of Oman. A very strong shareholder base with commercial bank, Sheikh Suhail Bahwan, together jointly own 49%. And then different government entity, in particular the Social Protection Fund, owned in totality 35%. The bank has been embarking on quite a bit of an investment in technology to offer customer an efficient digital experience. A lot of our customers have been talking highly about our mobile application. We've launched new services over the past 6 months, and in particular, you would have seen the press around the Eid Khorda, which is quite an innovative approach for distribution of the small denomination. The bank has been founded in 1973 and will continue to move ahead on our strategy. We have a very strong and well-established relationship with government, prominent companies, families, and individuals. A new senior management came in end of 2020. We continue to build a very strong team with not only the first line, but both the second and third line of the structure. 2024 is our 4th year of our 5-year strategy. We believe that a lot of the objectives that we've set for ourselves and committed to both shareholders and our board have been met or on its way to be met, inshallah, by end of this period, which is December of 2025. We're embarking in discussion with the board and other stakeholders in terms of our new 5-year strategy that will start in 2026. The execution, as I mentioned, of our 5-year strategy has been on track. We've gained market share in both the asset sides, which is loans, and on the liability side, which are deposit. And we continue to execute our strategic priorities at the required pace. We believe that this financial position and the market share that we've gained and the technology investments, in addition to the strong shareholder base, we will be able to capture the opportunities that Oman is providing, especially with the strong performance of the Omani economy, supported by or evidenced by the upgrades that had received from different rating agencies. Next couple of slides are just generic slides about what are Oman economic diversification strategy. I think a lot of the audience here are Oman-based, so with your permission, I'll skip these slides and move into the performance if there's no strong objections. I'll move to the next section, or if people would like to hear us take you through these slides, do let us know. Any views? So I'll go to the slide number 10. This is a slide that since we started engaging with the investor base, we've been presenting that. It's not a secret. These are the key priorities of the existing 5-year strategy, in addition to the 9 focus area. Our key strategic priorities are safeguarding, ensuring that we have a very strong financial and operational setup to ensure that we are able to manage and navigate any uncertain conditions that might arise. And as you would have witnessed, there have been quite a few over the past years. The second priority is then, after safeguarding our bank, is to create value. And this was kickstarted through actively driving cost optimization, in addition to bolstering income by focusing on revenue streams that are low risk and leveraging our existing client base and partnership. Finally, we want to make sure that all these activities are sustained. And this would only happen if we continue to invest and build in a lasting capability and digitize the bank's operating model for better appeal and scale. And in particular, the people side, by training, hiring, recruiting, and retaining good talents. Slide 11. These are some of the key financial highlights. I'll take you through this, and then I'll request Mr. Giri to take us through the operating performance. So key performance highlights for first half of 2024. Net profit was about $80 million, which was an increase of 5.3% over the corresponding period. Our asset base has touched $12.9 billion, an increase of 10.5% compared to the historical time. Customer deposits as of half year was at 10.4 billion, which is a growth of 18.9%. Again, a very strong indication that the franchise is very strong in generating customer deposits on our asset book. Gross loans and advances as of half year was about 10.1 billion, which is a growth of 7.1% compared to the same period of last year. Liquidity and capital are two elements that we don't undercut, and we are happy to see that our liquidity asset ratio as of 30th June has improved to 22% compared to 19% during the same period of last year. Fee income, this is another focus area of ours, have shown a very strong performance, growing by 18.7% to $56.8 million. Net impairment was 19.8 compared to 24.8 for the corresponding period of last year, which shows a reduction of 20%. There's a strong recovery activity that has happened during the first half, and in particular the second quarter of this year, which has helped us reduce the net impairment for the bank. This is the key financial highlights, and request Giri to take us through the details.
Thank you, Abu Hisham. Good afternoon, good morning, all of you. Happy to see all of you. Firstly, thank you. Am I audible? Yeah, thank you. Once again, good morning, and thank you for your time today. As Abu Hisham just set out, as the CEO just set out, we have a clearly laid out strategy, and we are executing to our strategy. So The first half of 2024 is a good performance from us, making progress on our strategy. Slide sets out our income. On the right side, you see the matrices. We started out with a cost-income ratio which was not in line or which was higher than market. We strove to improve that. We achieved progress during the first half. Our performance in the first half, like most other organizations, financial services organization in Oman, was impacted by higher cost of fund, and I'll talk about that in a minute. So the higher cost of funds, the interest rate environment clearly impacted us as it did to the other banks as well. Despite that, we made progress because our lending, as we said, safeguarding our assets and growing in a manner that fits our risk appetite has been our focus. So we continue to grow in the GRE segment, where the margins are a little bit tighter than what you would expect in some of the other segments. Later in the slides, there's a breakdown of the loan book, and you will see that we continue to grow in the GRE segment. Clearly, as a result, and we continue to invest, we continue to optimize our cost, but we don't shortchange on investment in technology and in our people. That helps us to manage the cost-income ratio. Return metrics are slightly lower, but that's a result of our the high cost of funds. But other than that, we continue to do well on these two lines at our operating income level. The impairment line, maybe I want to spend a minute. You will see a year-on-year decrease. That's not because we've not provided or anything. We have some of the best coverages here, especially considering the book that we have in terms of the GRE. But what happens is obviously that the recovery line has been better for us during the first half of 2024. As a result, you see the impairment number lower. But if you look at the tables below, then operating income composition, as well as the net impairment number and the profitability matrices that we talk about, right? The cost-income ratio for the first half at 40.78. Similarly, the return on equity at 9.18 are the NIMs at 2.36 and return on assets at 1.27%. These reflect well on our performance for the first half, clearly, although impacted through the higher cost of funds. That was my call out from this slide. I'll quickly talk about the other slides. Obviously, I'm keen to understand your questions and to be able to answer them, and a lot of familiar faces on the call. So I'll quickly talk through these slides, given these numbers are at least a couple of months old now, right? So if we can move to the next slide, slide number 13. It talks about our asset quality. Yeah, thank you. It talks about our asset quality and where our loan book growth, where you see growth in the first 6 months as well as on a year-on-year basis has been robust. We continue to grow as set out in the strategy on the sovereign stroke GRE exposures, and there is a pie chart which gives the breakdown between various sectors as well. The other columns in the slide talk about the provision call-out ratio. One would argue, why did your provision coverage ratio decline? It's, as I said, it's also a factor of the exposure and the overall book and the point-in-time metric as opposed to any other thing. If you look at the NPL ratio, though we're significantly better than what we were last year, our NPL ratio now is at 4.4%, down from 4.7%. If you looked at, and for people on the call who have been speaking to us regularly, you will recognize that not long ago, this ratio was just about 5% as well. Similarly, the stage 2 loans, has come down as well. So overall, we provided this coverage by stages, provisions as well as the exposure by stages. Other than calling out that the loan book continues to be healthy, our asset quality continues to be healthy, and that we provide on a prudent basis, there's not much that I have to call out on this slide. Okay, I'm going to move on to the next slide, which talks about the capital and funding and liquidity very quickly so that I can open up for your questions. Clearly, longer dated deposits we took. The focus here for the CEO and I and the new management team has been to build a customer-led franchise. If you look at our balance sheet, then you'll be able to see that how we've grown a customer-led balance sheet as opposed to wholesale where we relied on interbank borrowings or anything. So our focus has been to reduce that and build a customer-led franchise that's reflected in the balance sheet as well as the ratios that I'm going to call out here, right? If you look at the liquid asset ratio or the the funding mix, then you can see that we've built a customer-led franchise. Clearly, one of the callouts this year has been that the CASA ratio has remained just below 50%. We explained to you earlier on that CASA is not just about CASA, it's also about the pricing. We took a concerted approach to shift some of the expensive CASA to term deposits. And in an economy where the interest rates were going up, you would expect customer behavior to shift towards term deposits. We are not an exception. That's a trend that you notice in the other banks as well. But going forward, you would think as interest rates come down, then we and the other banks would obviously, push towards lowering the interest rates that we pay for these, and also start seeing more through the CASA. That's how we look at this. In terms of capitalization, we were at 16.2 at the end of June. Clearly, against a total minimum requirement of 13.5. CET is at 11.6%, with a comfortable buffer. We did take an action. We mentioned to you all that last year we had an approval of 81 for 300 million, of which we completed a part of the issuance. We are looking for the right time to complete the remaining right conditions, market conditions to complete the remaining portion of this issuance. So that sets out what I've been repeating in terms of being liquid, well capitalized, maintaining a good asset quality, which then helps us to grow profitably in the short, medium, and long term. We have explained to you that our focus is not, we don't manage the bank by quarter. We want to make sure that we have a robust franchise, and the first half results for 2024 reflect actions towards that step. Let me stop here and open up for comments and questions.
Any questions?
Please feel free to speak. Yes, go ahead. Vision Capital.
Hi, good morning. Am I audible?
Yes, you are.
Hi, this is Vision from Vision Capital. Thank you for the call and the presentation. Just wanted to actually get some clarification regarding the provision coverage calculation. Now, if I look at what you've reported in terms of your notes, we have a provision number of or stage 3 loans of 172,468 that you mentioned, right, in your notes. And then on top of that, we have a balance sheet number of 164,189. So when I divide that to the provision coverage comes to 95.2%. And you mentioned that the provision coverage is 98%. So if you could just clarify the same to start with.
Bishan, give me a minute before we answer that question. Go to your next questions.
Okay.
Sorry.
Wanted to actually start with that as a build up on more questions. But okay, in general, in terms of now the anticipation for the economy is the timing of interest rates cut and not whether or not they will happen. And you were prudent enough to mention how you why we witnessed a drop in CASA, and I completely understand that you wanted to retain the customer and you were anyways paying high amounts on the call account, so might as well shift them to the term deposits to safeguard that customer base. In terms of the deposits that you booked at the high interest rate, what was the average duration of these deposits? If you can just let us know so we know till when this high interest base will affect the bank.
Yeah, let me answer the question, and then maybe CEO would want to add. So from we try to take deposits. Not only pricing, right, Vishen? There's also the maturity of assets and liabilities mismatch that we need to manage, something called as MAL, right? That we, in terms of central bank guidance, and we pick that up. How do we look at this? Largely, these deposits are 1-year deposits in Omani Riyal, and some of it are maybe 2 to 3 years, but that's a smaller component. So to answer your question, the majority of this would be running off sometime in the first half of next year. But the renewals of that is where we've all the banks compete for a similar pool, right? And therefore, we are trying to work with our customers to say what else do we package, right? We've been very transparent the way we price our deposits. So we're working to them to lower these cost deposits. So I'll answer the question. Yeah. Did I give you some color on that?
Okay, sure. No, that's okay for now. Next, I want to actually tie up on the cost of funding further. Now, if I look at your loan book, it's as of this quarter, it stands at, let's say, 60-40 corporate retail, right?
Yes.
And the market average is 65-35. Now, one of the questions I had with the other bankers previously was that on one side, you will see a drop in, your cost of funding, and hence the deposits interest expense will go down. On the other side, you also have this corporate book which has been repriced, and going forward as the interest rates drop, you will see some repricing pressure from your customers as well over there, and some that are just embedded the way they are. So what sort of net impact do you see on your overall spreads and margins going forward, let's say over the next 4 to 5 quarters post interest rate cuts?
You and I have a similar view in terms of forward-looking guidance, right? We don't publish NIM's forward-looking guidance, but I would say the following and then ask the CEO to comment. Clearly, the key is going to be, and we mentioned this in one of the earlier calls, is managing this liquidity and the mismatch as well as the pricing. Clearly, I see a scenario where, Manas, there's a lead time between what the US dollar interest rates move and it translating into local currency, right? There's a lead time. So I think in the medium term, over the next 6-12 months, if we can work towards getting this right, I think we'll be overall in a neutral to positive impact position is how I would see, as opposed to sort of, going big time negative is how I would see it. But that will require a lot of careful management of both the deposit pricing as well as asset pricing. I think, over the last 12 months, the depositors had the upper hand in terms of the pricing that they commanded for deposits, with all of us willing to pay, 5.5% for 1 year money. I think, as we reduce that rate, I think the balance will shift a little bit. If carefully managed, I think we can land up in a neutral position is how I'd see it. Abdullah, do you want to add anything to that?
Let me just add. I'll try to attempt to answer both your questions, the second and the correct questions. So basically, like we mentioned multiple times in previous calls, the trick over this period of time, or the key magical solution, is the liability management. There are certain limitations that we have, which Giri had talked about, which is the manage. So it's not simply only a liquidity action, but you need to manage the mismatch between your assets and liability with certain clear regulation about how much of gaps you can run in the bank. So the trick is how effectively you can utilize this regulatory allowance, if you want to call it, to manage a little bit on your cost of fund and its impact on the cost of fund. So that's number one. Number two, and this is in particular for NBO, like Giri has said, we ensured that we are a customer-led franchise on the liability side for sure. That helps us to have a little bit of more bargaining power in terms of the negotiation and our ability to reprice our deposit at a faster pace. And I think the market has recognized that. We also diversified the sources of deposits, customer deposits, not even syndication or bilaterals, which is usually another source of funding. That's not the deposit. And if you see in Q1 in itself, there was a substantial growth in the deposits. And that's because we were able to garner or attract good amount of deposit from different sources. That has helped us to position ourselves very strongly, and it came at very attractive pricing. Position ourselves to be able to quote or negotiate a more attractive pricing on our deposit. The aim is to continue to move faster on the liability side than the asset side, the repricing, like you rightly mentioned. Given the cuts in the rates, we will see both pricing should come down, but we are moving faster on the liabilities side than the asset side. I hope I answered your question.
Yeah, that does. Thank you. Before we go on to the provision coverage part, if you could just explain on the performance of the Islamic banking for Q2. I noticed there's a loss on the Islamic banking in Q2 versus Q1. So in Q1, you had a profit of 2.6 million, and I believe there's a small loss on the Islamic operations in Q2. Is that understanding correct? And if you could just elaborate on the same.
Actually, rather than for the past now 18 months, we've been focusing on the Islamic banking window called Muzan. Muzan was one of the first entities that, sorry, I'm just looking at the numbers.
Please, yes.
Yeah, so actually, the performance of Muzan has been higher. For the first half, we've achieved a net profit of 3.55 million compared to 1.45 million for the first half of last year. So a growth of around 145%. They've been concentrated efforts on Muzan side and developing Muzan. So we've invested quite heavily on the technology to bring it up to par with the conventional side. We've augmented the team to help drive this growth. We've also sought the help of the conventional side to ensure that Muzan also is clearly articulated and marketed as an option for our customer base. As a result, that has helped us grow the profitability of the bank. Again, I'll repeat, for the first half, we were at 3.55 million compared to 1.45 million Riyal Omani, talking about Riyal Omani, for the same period of last year. If you can refer to us on what is your source of information, maybe we could even offline. If you could let us know the source of that information of the loss, we could just maybe answer that. But
I was actually referring to your notes for the second quarter, page number 20, which is segment reporting. So I always look at the data that you publish. So if someone could on the team over there pull up your financials uploaded for second quarter, segment reporting, which is the 29th section on page number 20, and that's where you've sort of reported, as per your different business lines: retail banking, wholesale banking, international banking, Islamic banking, and funding center. And there you mentioned a net profit of 2.605 million for the first 6 months. And the similar number in your first quarter reporting, page 19, was 2614. So we have 2614 for the first quarter and 2605 for the first 6 months, which gives me a net loss of 9. So I was just wondering, that's my source. It was from your notes. Unless I've missed out something, I'd be glad to correct that.
Yeah, John, you want to talk about some reclassification, particularly this must be the reclass between the conventional. Bishan, I'll pick this up offline with you on how we do a little bit of a reclass. There may be a
absolutely fine. Yeah, that's fine, Giri. That's fine. Perfectly fine.
Thanks.
No worries.
Thanks.
No worries. Just wanted to bring it to your attention. Okay, the next query.
Yeah, on the provision coverage issue, unfortunately, I'm not in the office to be offline, but we'll explain. 98.3 is correct. And Swami, do you want to answer that question?
Sorry, hi. The calculation of provision coverage is 98.3, which is right, because if you look at the slides as well, in terms of Riyal Omani period of the numbers to you, the NPL is about 172.5 million, and the corresponding provision, what we hold is 169.5 million. So that gives you a coverage ratio of 98.3%, which is what we have represented in the presentation as well. The numbers are in USD.
So if you
sorry, yes, go ahead.
So if you want further details or you want to chat up with me, I'm available on Sunday.
Fine. Well, what I can do is I can take this offline, because we generally refer to the number given in your balance sheet of 164. So I agree with the 172, but I was just wondering sort of what the numerator was. We can discuss that offline. That's fine.
Yeah, okay, no problem.
That's fine. Yeah, last question from my side before I let my peers, ask the queries is, you've mentioned and we've seen the traction on sort of, increased market share. You had mentioned clearly that you're the oldest bank, and somewhere over the years, probably the focus on being the market leader, profitability was obviously always a focus, and we've seen that happen. But in terms of market share, we've seen a standout sort of market leader in Bank Muscat, and then there's a clutter of probably 3 to 4 banks which are in that similar 10 to 12% market share segment. Now, how do you see your strategy pan out going forward? And I'm saying that especially with regards to CASA. And when I'm talking of CASA, I'm talking very, very specifically about just the savings account as a percentage of overall deposits. So I understand that there's been a drop in overall CASA, and that's because there's been some mobilization from the call accounts to the term deposits. And I completely understand that. But when I look at purely savings account, and we do this across the sector, if I'm not mistaken, NBO stands at 14.7%. And the market average is around 15.5%. So purely on the saving, because that's the true low cost deposit base, what's your strategy and sort of how do you see that number panning out? And because in one case we've seen a consolidation in the sector, in one case we've seen the brick and mortar approach of adding branches. So just wanted to understand what's the strategy from NBO specifically. Thank you.
Yeah, Abdullah, do you want to add? Do you want to say a few things before I add? All right, want me to go first?
I'll start again. So basically, you're 100% right. That's our approach. Size per se is not the only objective for us. There are a number, when we articulated our 5-year strategy that, like I mentioned, will end by end of 25. There are other matrices that are critical as well, in particular, return on equity, market cap, etc., etc. So size per se is not only the key metrics for us. So that's one. Number two, in terms of what you've mentioned, historically, NBO had one of the highest CASA ratios. But like you've rightly said, 2 issues happen. One, the conversion, given the interest rate substantial jump over the past 18 months, there's been a shift from CASA to term deposits, but also we gave up certain CASA that did not make sense. But more importantly than that, on the asset side, which links again to the discussion we just had, we had to go through a number of restructuring, which has elongated the tenors of the loans. And you know some of these names, where it used to be certain overdrafts and very short term in nature. We had to go through discussion post-COVID for restructuring some of these accounts and move them to term deposit, term loans, and some of them have reached maybe 10 or 15 years. So to manage the gap and the mal regulation, we also had to take some longer term deposit to help us managing the mal regulation that we talked about. This is just the background. In terms of our approach, we are doing a mix. We are not ignoring the bricks and mortar, but we don't believe in a large-scale deployment of branches. We feel that, and especially after COVID, we believe the market is ready to look at digital solutions. And that's why we've invested heavily in terms of digital onboarding. We've launched a number of products on our mobile app, for example, loan top-up. Now that can be done seamlessly on our mobile application. Cards against deposit or secured by deposit, that can be done now online. Samsung Pay, we were the first bank to launch it, and more are coming, and we are working in tandem with the regulatory allowance that is there. So we are doing both. We are renovating branches, we are relocating branches, we are looking at new location for branches, as well as investing in our technology platform, because we believe that as a country, we are ready for some digital offerings there in particular. So that will help us in terms of expanding our reach and our channels without necessitating us to expand our branch network. This is very similar to what I've said about Mosul. The focus is there. Rather, in Mosul, maybe we might speed up a little bit of the branch expansion because Mosul currently has only 6 branches. We are in the process of officially opening one more and maybe another before end of this year or early next year, in addition to the plans for next year as well. So maybe on Mosul, we might see more branch coverage. But again, digital is another focus area for Mosul.
All right. Yeah, that's it from my side for now. I'll go back in queue and let my peers ask the queries. Thank you so much once again and wish you all the best.
Thanks, Bishan.
Go ahead.
Yes, hi, good morning. Thank you, team. Thanks for the presentation and thanks for taking my question. So my question is more on the broad level, and I'm specifically looking for your comments or your views on how the credit growth in the in the country is growing. What are your views, and how specifically are you seeing it for NBO? And are there any particular sectors which you are seeing growth, higher growth relative to other sectors?
Basically, our approach since the start of this 5-year period was to focus more on the GRE. As Giri had mentioned, it might come in with a lower margin, but it saves the bank and saves shareholders the cost of credit, the NPA potential that might have. I think the results of the bank over the past 3.5 years have clearly demonstrated that this strategy was the right strategy. Rather now, and also at that stage, post when the economy was coming out of COVID, there was quite a bit of risks that was there in the market. We were focused on restructuring a lot of accounts that were both in the large segment as well as in the mid and small segments as well. We believe now the economy is well positioned to offer a lot of opportunities. We've started seeing opportunities emerging on a few large-scale projects that the government has announced. For example, the expansion of the expressway, the PPP projects on roads in the southern part of the region, the 40+ schools on the PPP structure. So these are opportunities that provide, these are projects that provide opportunities for bank to fund, number one, the developer of these projects, the private sector that are going to develop these projects, fund the construction companies, suppliers of these companies. So we see a lot of opportunities from those perspectives. Oil and gas continue to be a strong performer with the continued investments that is happening in that area. So these are the two key areas for us, in addition to any emerging opportunities that might come in. We have the liquidity, we have the capital, and most importantly, we have the right people and talent to support us or enable us to capture these opportunities, because it's not anymore the old banking approach. It has become a little bit more complex. We need to look at multi-factors, and we believe we have a very strong team to capture that.
Yeah, okay. So thank you for the comments there. Is it possible to, bring in some sort of numbers, like from what we've understood from, all the other banks presenting in the region, that, we are expecting Oman banking to grow in, say, mid-single digit growth. So I would, what I'm looking for is is how would NBO grow in that sort of a scenario? Are you looking at inline growth with the Oman banking sector, or could we expect it to be a bit higher than what the, the overall sector is growing with?
matured as an organization to give forward-looking number or guidance. But my belief as a banker is to ensure that I manage any growth opportunities with the right liability side of funding profile. So I believe that low double digit and on the higher end to high single digit growth rates is the right approach given where we see the liquidity position, the whole economy.
Okay, great. Thanks for this. And then, is there like, so I understand that, NBO has one of the higher component of fixed rate loans, which is the higher retail. So in such a scenario, when there are interest rate cuts, you guys are, expected to benefit significantly in terms of NIM expansion. Is there a sensitivity to, 25 basis interest rates that you can provide us for your NIMs?
Yeah, Abdullah, do you want me to pick the question up? Yeah. Hi, Deepika. Thanks
Yes.
for joining us
Good morning.
today. Good morning, and thanks for joining us today. Look, is there a sense, will we benefit if cost of funds come down? Of course, we are going to benefit. We will benefit. But having said that, you're familiar with us and you're familiar with the other banks as well. Repricing retail assets has not been easy, isn't it? So when the rates went up, neither were we able to reprice them so quickly, right? So I would expect, there'll be a period before we, quite a period before we pass any reductions to customers on retail loans, right? Most markets around the world, cost of retail loans have gone up. In Oman, we had the 6% cap, and as well as repricing hasn't been particularly easy. Therefore, I would expect quite a while before any reductions are passed to the retail customer, number one. Second is that, I'm in line with what we've always discussed with all of you. I don't want to put out, forward-looking, saying, hey, 25 basis points will give this sensitivity, etc. Come year and maybe come Q1 next year, maybe we'll be in a better place to look at, some forward guidance, given that we would have finished or we'd be at the end of 2025. We complete our first 5-year plan, and then we can put out, if appropriate, and in consultation with the stock exchange, some forward-looking guidance. Okay.
Sure. Thanks for that. So one last one from me. So on the cost to income ratio, we've noticed significant progress over the years. So how are you looking at it, going forward now that, you're towards the end of your first plan? And then, so how are you expecting it to progress? Could we see further upside from these levels?
Yeah, it's a great question. I'll answer the question a little bit and then ask the CEO to add anything you want. He covered in the response to the deposit question. He covered our approach in terms of branch banking, right, and technology. We believe that we're the first local bank. We've been here 50+ years. We don't take shortcuts on our investments. What we want to do is create a franchise that's there for the next 50 years, next 100 years, right? Therefore, if there's space in the P&L, then our first priority is going to be investing for our growth, for our future growth, and particularly two areas which I've repeated, CEO repeats as well, are very dear to our heart. One, our people. Second, technology. This would mean that personally, I wouldn't want to see the cost income ratio move materially downwards from 1 or 2 percentage points. Yeah, fine. But I wouldn't expect a material reduction from these levels, please.
All right. Thank you so much.
Comments. This is Abdul again. I support Gary's comment. I think we've reached to a level that is a good standard for the Omani context. We do have some maybe structural differences from what you would see maybe in the region context. We have a larger country. We need to spread our branch presence across a larger geography, etc., etc. But key aspect is we continued, even with the cuts and optimization, we continued investing in the right place. Rather, our approach was not cost cutting, but cost optimization, moving certain costs that was wasteful, unnecessary, and directing it to the the right location. Going forward, we believe that we should continue in that, calibrating the physical branch expansion with the digital investments that we already embarked on. So I think for us, we cannot ignore both, but also we cannot have a heavy branch physical expansion on.
All right. Thank you so much. Wish you all the best.
Are there any further questions? No more questions?
Hello?
Yeah.
Yes, I was kind enough to allow others to ask queries, but I'll take advantage of this opportunity. If you could just talk about the risk in the system that you see, and specifically to NBO. You've spoken about sort of how there was a restructuring exercise, and that was probably the need of the hour a couple of years ago. Now, if I look at your gross NPLs, they're at 4.4%. Coverage, like you said, is 98%. If you could just talk about sort of how you look at the risk in the system, because we try and track the restructured loans as well as the percentage of overall gross loan, and that number is exceptionally low for NBO. Probably it might be a difference in formula calculation, but that number stands at 5.9% for the quarter compared to 10% for the banking sector. So what sort of discussions are you having with your leading clients when it comes to the risk profile? How have you seen things change in terms of cash flow on the ground? That's one query. Second is you mentioned that you've seen some, I know it's with regards to the loan book and deposits. You mentioned that you saw mobilization of deposits in the first quarter from the GRE segment, if I heard that correctly. And in terms of loan opportunities, also you see that with the GRE segment. So if you could just sort of elaborate on sort of the strategy over there, because I understand the at least on the loan side, the idea is to manage risk. So while the spreads might be lower, there's a less sort of risk profile over there, which helps. On the deposit side, what sort of rates you've seen with the GRE segment? Because we do understand they're quite competitive when it comes to sort of booking deposits. And we're still in a scenario where interest rates haven't dropped yet. So if I see that number going up in Q1, this makes me wonder in terms of what discussions you had with the counterparty when you booked those deposits. Thank you.
Yeah.
Okay. That's the question. See, a lot of what we've discussed are factors in answering your last question. So, number one, our focus on the GRE has helped us improve our risk profile of our loan portfolio. I think if I'm right, more than 70% of the growth is from GRE. Or even if it's non-GRE, there is a component of GRE or government linkage there. We've reduced substantially, and if you look at the sectorial breakup and compare it to the rest of the banking sector, we've reduced our exposure in many, let's consider high sensitive sectors of the economy. And we've exited a number of those relationships, given our appetite. Plus, we wanted to ensure, like I said, safeguarding our balance sheet during a period of time. So that's the reason for the differential in the quality of the book. But on the liability side, it's not necessarily only a deposit led, but also the investment that we've done on the technology, including the wholesale side, be it government or corporate. So the B2B, the different solution, direct debit, etc., has helped us attract float that we are benefiting from. We are one of the largest payment banks in the country, probably the number 2 payment processing bank. We are one of the largest salary processing bank in the country, with a lot of the large entities using our services. The payment gateways and other solutions has helped us also improve the float business for us. So that is also helping us in generating liquidity for the bank and managing a little bit on the cost of fund side.
Also, thank you. Just, if I may add, Bishan, also you look at our percentage on your percentage as our restructured loan being lower. Look at this in the context of exposure to construction sector, please. So you get your answer.
Yeah, 4.5%.
So we are low.
Correct. I've witnessed that.
If you look at, so if you correlate the two, then you have the answer. Okay, so that's how we look at it. And Abdullah has provided a very comprehensive answer on how we look at it, right? We'll reiterate the message that the key is, and that we've said to you for the last 18, 24 months, the key is managing the funding cost, how we manage the liquidity, and also where in the case of NBO, where we've really worked hard to reduce our cost of credit for the last few years by changing the mix of the book, is maintaining these three elements, and we are working towards that.
Interesting. Actually, that brings me to a different question. Sorry to digress. I can clearly see the exposure to the contracting sector. It's clearly the lowest in the banking sector, and point well noted. But you also mentioned of PPPs as a potential growth opportunity. Now, if you could just explain the mechanism there, not in terms of the workings, but that would involve dealing with the contracting sector going forward. And if you could just touch upon that in terms of added exposure to that sector.
So, like I said, we've managed exposure to high sensitive sectors, but things do change. Risk appetite and risk profile also changes as we progress, as the economy develop, as liquidity situation improve, etc., etc. But in particular, the construction sector, we did not go to zero. We do still have strong relationship with the top construction companies that we believe are the most prepared to capture these large-scale projects in the country. So we believe we are positioned. So we've managed the risks from that sector, but we still maintain with the right companies that would have these potential, and the names are well known in the market. So I don't think these are necessarily contradicting approaches at all.
Noted. And one last query from my side is, when it comes to fee income or other operating income, is there a yardstick that the bank sort of benchmarks itself to in terms of contribution to total income or as a percentage of assets or some other qualitative metric? If you could just elaborate on the same and what's the strategy over there?
How we look at is percentage contribution or of what we call non-funded income. We would like to see always hovering above the 30% threshold. It's not easy, but we've been investing in a number of business lines that are pure fee-based. We've launched about 18 months ago a private banking proposition. We've revamped our investment banking proposition. We recently launched a new global fund, which is locally domiciled. We're looking at more activities on that front. Our investment banking advisory side has been active, but more on the debt. If you remember, the first IPO from OQ Group, which was Abraj, was co-managed by NPO, and that was a good success. We would like to participate more and more there. We've augmented the team, we've invested the team there, as well the asset management and private banking areas. On the corporate banking side, trade and trade finance is another focus area for us as well. So we're looking at these kind of areas to contribute more and more and reduce our dependency on net interest income to a level that is hopefully below 7%.
Noted. All right. Thank you. That's it from my side.
Vision, while I have you online, you've got on the provision coverage, you were reporting at 164, and you need to add the 5 million of off balance sheet as well, and that's how you get 169.5. That's how the industry does it, and I'll take you through the specifics on Sunday. Okay, but this is how we do it.
Deeply appreciate that. Thank you so much.
Thanks.
Any questions from the audience? No questions, so we can end the call.
Thank you very much for sparing the time. We are happy to receive any further queries you might have via email or call. Happy to answer any further questions. Thank you very much for taking the time.
Thank you. Thank you for your time.
Thank you. Thank you.
Thank you all.